Well, for more, let's talk with Mikio Kumada. He's in Singapore. He's global strategist at LGT Capital, which manages about $24 billion of assets. Good to have you, Mr. Kumada, on the program. So, first of all, we're in a bear market. The MSCI All-World Index here down more than 20%. Would you, at this moment, be advising people to buy equities?
No, actually, the opposite is the case. Just yesterday, we decided to reduce our allocation to equities further. We were already underweight equities. Now we're a bit more underweight by reducing our exposure in emerging markets, in particular, even more. So I would still stay on the sidelines.
All right, so you've changed your strategy slightly, given developments in the last few days. What developments are most significant? I mean, do you now expect a global recession?
Well, we think that with the decision that the Fed took yesterday, the risk of a recession has increased further. We already saw a significant risk of a recession. Maybe now it's much closer to 50-50 or above 50-50. That's very hard to say. But certainly that is what markets are pricing in. And I am afraid for any short-term relief in the equity markets, the recent decision by the U.S. Fed was much too tight in monetary policy terms.
Now, John Woods was on the program an hour ago. He's from Citibank Private Bank. He says equity markets could fall another 30%. Do you agree with that?
Well, we don't like to put precise numbers on potential declines, but of course it's possible. But I think the important message is that we also see a risk of a further decline in equities, however big or small that may be. But there is a big risk of a further decline, yes.
So you've increased your cash quota, but you've changed how you feel about the U.S. dollar after the Fed decision.
Yeah.
Explain that for us.
Well, the Fed decision, essentially, there were expectations ahead of the meeting that the Fed would do more of the so-called QE, or quantitative easing, i.e. print money. The actual decision was to print zero amount of new money because they're selling $400 billion in bonds and buying $400 billion in bonds. So the net amount of liquidity or of money printed is zero, if you allow me a simplified expression. So that is much too tight compared to what the markets were expecting, and it is a net positive or a slight improved situation from a currency point of view, makes the dollar more attractive against other low-yielding currencies, particularly at a time when short-term interest rates in Europe are likely to go down.
Right, so the dollar is not a bad bet, but you're not giving me any convincing arguments about where to put the where to put my money. What are you telling people?
Well, we are telling people right now to stay on the sidelines. I think that is the most important message. As you may see in our allocation, our most extreme bet, if you will, is cash at this very moment. But we also like some smaller segments of the asset world, so to speak, such as gold, which still looks okay at the time of crisis, and also emerging market bonds. Even though they have been correcting recently, we think the macroeconomic case is much better than for the developed world, certainly. But the safest place for the moment is to be in cash and to wait to see what happens in the near term.
Mikio, which emerging market bonds?
Well, we look at it not in a specific regional. We don't differentiate into national environments, but we look at the asset class as a whole. The issue is actually finding enough government bonds in these from this category of countries, because of course they have much less strained fiscal balances, which means they don't need to borrow as much. So it's a small bet, if you like, and a small asset class. We like it in general.
All right, we've got to leave it there. Mikio Kumada, global strategist at LGT Capital Management, coming to us from Singapore.